The next financial crisis will not look like 2008. There will be no dramatic crash on trading screens, no lines outside collapsing banks, but its impact will reach every household, every paycheck, and every corner of the global economy. Because this time, the storm is slower, quieter, and far more pervasive. It will begin not in the reckless corners of finance, but at its very core, inside the balance sheet of the United States itself. In 2008, the system failed because of greed, leverage, and bad mortgages. But in the 15 years that followed, we replaced one form of excess with another. We built an economy sustained by the illusion of free money. When the Federal Reserve cut rates to near zero and began buying bonds after the global crisis, it wasn't just an emergency measure. It became a habit, a new economic religion built on liquidity. Each shock was met with cheaper credit, each slowdown with a bigger safety net. Markets learned to expect rescue. Governments learned to spend without restraint. Debt stopped feeling dangerous. For most Americans, this era didn't look like danger. It looked like prosperity. Stock portfolios grew, home prices climbed, credit was easy. But beneath that surface, something fundamental changed. Money lost its meaning as a signal of risk. And when money loses meaning, markets lose discipline. Cheap credit became the oxygen of the modern economy. Corporations borrowed to buy back shares. Governments borrowed to cover deficits. Consumers borrowed to preserve lifestyles that wages no longer supported. The national debt doubled, then tripled. By 2025, the United States owes over $35 trillion, more than the entire economic output of the country in a single year. Debt in itself is not new. What's new is the cost of carrying it. For a decade, interest was almost free. Then inflation returned. In 2 short years, the Federal Reserve lifted rates from near zero to over 5%, the fastest tightening in modern history. Suddenly, the world rediscovered the price of money. For Washington, that change is enormous. Each 1% increase in interest costs adds roughly $300 billion a year to the federal bill. America now spends more on debt interest than on national defense, more than on education, healthcare, or infrastructure. Every new dollar borrowed comes with a heavier chain attached to it. This is the new fault line, not subprime mortgages or exotic derivatives, but the simple arithmetic of debt and rates. The United States is paying interest on past prosperity, and the bill is accelerating. For households, this dynamic feels different than 2008. Then the pain came from collapsing markets and job losses. Now it comes from slower erosion, from higher mortgage payments, rising rents, and shrinking savings. You don't lose your job, you lose your margin. You keep working, but the numbers no longer add up. For small businesses, credit lines that once cost 4% now cost 8%. For young families, the dream of home ownership drifts further away. For retirees, the bond portfolio meant to provide safety is suddenly volatile. Every corner of daily life bends under the same invisible weight, the price of money. The United States Treasury is supposed to be the world's safest borrower. Treasury bonds are the foundation of global finance, the asset against which everything else is measured. Banks, pension funds, and central banks all hold them. But safety depends on trust, and trust depends on liquidity. What happens when even the safest market begins to shake? Over the past 2 years, major buyers of US debt have stepped back. China has reduced its holdings. Japan faces its own currency pressures. The Federal Reserve, once the largest buyer, is now a seller, shrinking its balance sheet. Suddenly, the endless demand for treasuries isn't endless anymore. Prices fall, yields rise, and the cycle tightens further. Higher yields mean higher interest costs for the government, which means larger deficits, which means more bonds must be issued. It's a self-reinforcing loop, the kind that quietly undermines confidence. This is not the kind of crisis that makes headlines overnight. It unfolds in spreadsheets and auction results, in the widening gap between buyers and sellers. Liquidity thins, volatility grows. Markets can digest almost anything except doubt about what is safe, and doubt is beginning to creep in. In October 2023, a 10-year Treasury yield crossed 5% for the first time in 16 years. That single number rippled through everything: mortgages, car loans, corporate borrowing. It marked the end of an era. Money once again had a cost, and the world had to reprice around it. The irony is striking. The same bonds that saved the world in 2008, by serving as collateral by anchoring confidence, could now become the next source of fragility. A liquidity strain in US Treasuries would be more dangerous than any bank failure because it would strike at the heart of the system that defines safety itself. For Washington, this creates an impossible dilemma. If the Fed keeps rates high to fight inflation, the government's interest costs explode. If it cuts rates to ease the fiscal burden, inflation returns. Every solution feeds the problem it's trying to cure. This is the paradox of the modern economy: stability built on instability, confidence built on debt. For years, the system rewarded risk because it believed the Fed would always rescue it. Now that belief is the risk. You can see the early tremors already. Markets swing violently on every policy statement. Bond auctions occasionally struggle to find buyers. The dollar surges and strains global trade balances. None of these are the main event. They're the warning signs. Tiny cracks in what used to be unshakable. Yet on the surface, life goes on. Jobs remain plentiful, stocks are near highs, and consumer spending still looks strong. That's what makes this different. The next crisis won't begin with collapse. It will begin with complacency. People don't panic when things look fragile. They panic when fragility is revealed. The United States is approaching that moment, where numbers that once seemed abstract begin to matter. When deficits, interest costs, and yields stop being topics for economists and start showing up in every household budget. The core of the next crisis lies not in risk-taking, but in arithmetic. The country borrowed for a future it assumed would always deliver growth. Now growth itself is slowing. Aging demographics, low productivity, and geopolitical costs all drag it down. The machine that once grew faster than its debts now struggles to keep pace. As the economy adjusts to this new reality, the tension builds quietly. Each fiscal year begins with a deficit. Each rate decision adds pressure. Each month, the Treasury must find buyers for hundreds of billions in new bonds. At some point, markets may simply demand higher returns for the privilege of lending. That's how confidence erodes, not with crisis headlines, but with fatigue. And when confidence fades in the world's safest borrower, every other borrower feels it. Municipalities, corporations, households, all pay the premium of lost faith. Credit becomes scarcer, growth slows further, and the cycle feeds itself. For the average citizen, it feels like stagnation that can't be explained. Prices remain high even when inflation seems lower. Wages rise, but not enough. Every financial plan, every retirement projection, every business forecast quietly slips behind reality. This is how a modern crisis begins, not in chaos, but in erosion, not through a crash, but through the steady decay of purchasing power, confidence, and momentum. And yet, because the United States still issues the world's reserve currency, it can delay the consequences longer than anyone else. It can print, borrow, and roll debt forward, while others cannot. That is both its strength and its danger. Because when the world's anchor is built on trust rather than discipline, the storm that follows reaches everyone. The last global crisis started with bad loans in American neighborhoods. The next may start with math in Washington. For now, the numbers still add up. Markets still buy, the dollar still reigns, and investors still call treasuries safe. But safety is not a law of nature, it's a belief, and beliefs change quietly until they don't. When that moment comes, it won't look like 2008. There will be no sudden implosion. There will be rising costs, shrinking options, and a creeping sense that the system no longer bends in our favor. We're not waiting for the next collapse. We're already living through its opening act. The story does not end at America's borders. When the United States trembles, the world does not watch. It reacts. Because every nation, every market, every bank that touches the dollar is tied to the same invisible web. The web that begins in Washington and stretches through every central bank vault and corporate balance sheet on Earth. The world runs on dollars. Roughly 90% of global trade is invoiced in them. More than half of all international loans are denominated in dollars. From a shipping company in Singapore to a power plant in Kenya, from a bond fund in Frankfurt to a miner in Chile, all depend on a currency they do not control. When that currency tightens, the world gasps for air. For decades, This arrangement brought stability. The United States supplied liquidity, the world supplied goods and labor, and everyone shared in the expansion. But the same mechanism that lifted globalization can reverse it. A stronger dollar pulls capital inward. Money flows toward US bonds, draining it from emerging markets. Imports become cheaper for Americans, but costlier for everyone else. Debts owed in dollars grow heavier when local currencies fall. The safety of one system becomes the suffocation of another. We have seen glimpses before. In 2013, the taper tantrum rattled India, Brazil, and Turkey when the Fed merely hinted at withdrawing stimulus. In 2022, as rates rose again, currencies from the yen to the peso slumped. By 2024, more than 30 developing economies were paying record interest just to defend their exchange rates. None of them caused the tightening. They were simply caught beneath it. In this sense, America's fiscal story is not an isolated drama. It is the script for global finance. When US yields rise, borrowing costs in Europe follow. When US consumption slows, factories in Asia feel it first. When the Treasury issues trillions in new debt, investors must choose: fund America or fund the rest of the world. Most choose America, and that choice leaves everyone else with less. For ordinary people abroad, the effects appear quietly. A farmer in Ghana pays more for imported fertilizer. A student in Egypt finds tuition higher because the local pound has fallen. An exporter in Vietnam loses orders as global demand cools. The crisis they experience does not come from Wall Street. It comes from the mathematics of the dollar. Even wealthy nations are not immune. Europe faces the same inflation without the privilege of printing the world's reserve currency. Japan, long accustomed to near-zero yields, now wrestles with the cost of defending its own bond market. China, the world's second-largest economy, holds vast reserves in US assets, the very instruments whose yields now threaten to erode their value. In every direction, financial gravity pulls toward the same center. The irony of this system is profound. The United States can run deficits almost without limit because the world still demands its debt. Yet that very dependence ensures that when confidence finally wavers, the shock will be global. A sell-off in treasuries would not stay domestic. It would ripple through currencies, interest rates, and balance sheets everywhere. The world's safety asset would become its stress test. In the developing world, the first symptoms would be familiar: foreign reserves draining, capital controls returning, IMF teams landing in airports with urgent programs. For families in those nations, it would mean rising food prices, power shortages, and vanishing credit. For investors, it would mean portfolios that no longer behave as models predict. Diversification would fail because everything that depends on liquidity would shrink together. This is how a modern crisis travels, not through bank runs, but through bond yields and exchange rates. Not through panic, but through pressure. Each move of a few basis points in Washington can change budgets across continents. A 1% rise in the US yield curve can erase a decade of fiscal planning in emerging economies. And as each reacts defensively, raising rates, cutting imports, freezing projects, global growth slows. For the ordinary worker in the West, it appears as another year of frustration. Higher grocery bills despite cooling inflation, mortgages that never fall back to old levels, paychecks that lag behind rents and healthcare, retirement funds that recover slower each cycle. The crisis does not arrive with sirens. It settles into daily life like a fog that never lifts. Governments respond as they always have, with promises of reform and packages of relief. But the deeper issue is structural. Every nation has built its prosperity on assumptions of perpetual growth financed by cheap debt. When growth falters and debt endures, the mathematics of stability reverses. Inflation becomes the silent tax that keeps the machine moving. Savers pay it through diminished purchasing power. Borrowers survive through its erosion. The system keeps functioning, but not thriving. At the center of this lies politics. In Washington, debates over budgets and ceilings mask a larger truth. Neither party can afford austerity, and neither can fund ambition. Cutting spending risks recession. Raising taxes risks backlash. The only politically acceptable path is the quiet one, letting inflation do the work. A slow dilution of value instead of a direct default. That is financial repression in its modern form. For the average American, it feels like being asked to run faster on a treadmill that subtly inclines each year. You earn more dollars, but they buy less. Your house may rise in nominal value, but insurance, maintenance, and taxes rise faster. Even success feels stationary. This is how an empire manages decline, not through collapse, but through adjustment. History shows this pattern. Rome debased its currency to pay its armies. Britain inflated away war debts after 1945. Every dominant power discovers that its greatest privilege, the ability to borrow in its own currency, is also its final temptation. Because once a nation can print the world's reserve, discipline becomes optional, until the world notices. And that moment of notice rarely looks like drama. It begins with subtle shifts, central banks diversifying reserves, trade deals settled in alternative currencies, investors demanding slightly higher yields. Each act small, each rational, each cumulative. Confidence erodes not through shock, but through choice. The question then becomes, what replaces faith in the dollar? For now, nothing. There is no alternative deep enough, liquid enough, trusted enough. But systems do not need replacements to decay. They simply need fatigue. As trust thins, volatility thickens. Nations hoard gold, build digital currencies, and seek bilateral trade to hedge dependence. Each move signals not rebellion, but preparation. In this environment, volatility becomes the new normal. A world addicted to cheap money must learn to live with expensive uncertainty. Corporations hold excess cash rather than invest. Consumers save not for growth but for survival. Have you ever felt like you're working harder but not getting ahead? That's not just you, it's a global squeeze. Governments are spending more because private money is too cautious, creating a cycle of slow growth and rising debt. This hits the middle class hardest. Education, healthcare, and housing costs are soaring, while our savings can't even keep up with inflation. We're running in place, trading progress for stability. The next financial crisis won't be a dramatic crash like 2008. It will be a long, slow grind that quietly redefines what's normal, shrinking our expectations to fit a new reality. It won't end with a big recovery, but will fade into a new baseline. Still, people adapt. We'll learn to be more resilient and cautious. The real test is whether our institutions, built for a different era, can keep up. The next crisis is already here, unfolding slowly, deeply, and it will be much harder to escape.